Yes, students. Now we will revise the fourth head of income, which is capital gains. Section 45 to 55A contains the provisions with respect to capital gains, and the tax rates applicable on capital gains income is given in section 111A, 112 and 112A, which we treat it as the tax rates on special income. And tax rates on special income, we already covered it in tax rates chapter, but we will learn it again in this head also, guys. Okay. Section 45 being a charging section for capital gains specified. If there is any gain on the transfer of capital asset which is affected during the previous year, will be taxable under this head. So there are three important terms which we need to understand here. That is capital asset, transfer and previous year. Because if there is a transfer of capital asset during the previous year, it is taxable year. Okay. Previous year we already learnt in section 3. That is, I have covered it in chapter 1, guys. And the previous year applicable for your exams would be the previous year 25, 26. Okay. The other two important terms has been defined in income tax law. We will see. Capital asset is defined in section 2 clause 14 and transfer is defined in section 2 clause 47, guys. So what is the definition? We will see. Yes. First, capital asset definition. Very important definitions, guys, because whether should we compute capital gains or not, whether it is taxable or not, depends on these two important terms. Only when there is a capital asset and when it is transferred, we will compute capital gains. Okay, fine. So first, we will see the definition of capital asset, which is given under section 2 clause 14. Capital asset means property of any kind held by the assessee. Whether he is using it for personal purpose or business purpose doesn't matter. But if an assessee is using an asset or property for business purpose, he will be claiming exemption on that asset under section 32. And it will be forming part of a particular block, guys. And if such asset is sold, then we will just reduce the sale value from the block and we will not calculate profit or loss on sale of individual asset when assessee is following WDV method. But only when section 32 fails, immediately section 50 will pitch in to compute capital gains. So, as long as section 32 continues, assessee is claiming depreciation means. If any asset out of that block is sold, will we compute capital gains? No. If depreciation is alive, then we don't claim or we don't calculate capital gains on such sale of asset. But only when section 32 fails, that is when all the asset in the block is sold or when there is no value in the block, then immediately we will compute short-term capital gain or loss as per section 50. And section 50 is a part of capital gains head, which we will learn little later, guys. Okay, fine, sir. Then any securities held by FII. Guys, if any securities held by foreign institutional investor, even though they would be outside India, they would have purchased it in foreign currency, it doesn't matter. It is a capital asset in India. Okay. Then ULIP, that is Unit Link Insurance Policy, issued on or after 1st February 2021. If exemption is not available under section 1010D for that ULIP, then it is a capital asset. Sir, when exemption is not available under section 1010D for ULIP is, if in any year, if the premium paid is more than 2,50,000, guys. If premium paid for this ULIP, which is purchased on or after 1st February 2021, even in 1 year, if premium paid is more than 2,50,000, then when the ULIP matures, there is no exemption available under section 1010D and it will be treated as the capital asset and we need to compute capital gains on that. And the computation of capital gains on the maturity of ULIP is not a part of your syllabus. You need not worry. Okay, sir. Then, but it does not include, means whatever I have highlighted in green color here is not a capital asset. Okay, what are those? Stock in trade, raw material and consumables. Sir, these are not capital asset because if stock or inventory is sold, it is taxable under the head PGBP, guys. So it is not a capital asset. Okay. Then personal assets of movable nature held for personal purpose. So personal asset of movable nature is not a capital asset. But there are few exceptions for it, which I have mentioned in the bracket here, which I have highlighted in red color. Jewelry, archaeological collection, drawings, paintings, sculpture work of art is a capital asset. Even though they are a personal asset of movable nature. Sir, jewelry, I am wearing, it is my personal asset. Still, is it a capital asset? Yes, guys. Then the definition continue. Rural agri means year, but does not include is there. No, we will continue from there. The list. Rural agriculture land means agriculture land situated where? In which area? Specified area or not a specified area? Not a specified area. Because if agriculture land is situated in specified area, it will be a capital asset. So your rural means not situated in specified area. If it is in specified area, we term it as urban agriculture land, guys. So that means urban agriculture land is an capital asset, whereas rural agriculture land is not a capital asset. Okay. Then gold bond or special bearer bonds issued by central government. So guys, I know here the definition might be little confusing for you. That is why I have used the color impact here. Whatever is in red color is actually a capital asset. Whereas whatever is marked in green, they are not capital asset. Got it? So please be careful. Next, section 2 clause 47 defines transfer. Transfer normally means sale, but here there are few important transactions are also covered which is regarded as transfer. So what are those? Sale normally is always a transfer. Okay. Exchange, sir, I gave my asset, you gave your asset. Sir, is it a transfer? Yes. Okay, maybe some amount of money also might be involved. For example, I exchange my old laptop for a new laptop by paying 20,000 or 30,000. That is called exchange. Yes. Then relinquishment means I'm surrendering my right in the property. Is it still considered as transfer? Yes. Next, extinguishment, that is cancellation of any right in a property. You might be cancelling it with consideration or without consideration, but is it still a transfer? Yes. Then compulsory acquisition under any law of any land or building for highway construction or for any metro extension like that. Okay. Then conversion of capital asset into stock in trade, important. If stock is converted into capital asset, it was taxable under section 28. That is as per PGBP head. Yes, sir. Whereas now if capital asset is converted into stock, is it a transfer? Is it taxable under the head capital gains? Yes, guys. Next, maturity or redemption of zero coupon bond. Is it also taxable? Yes, because it is a transfer. But zero coupon bond is something which is issued at discount and redeemable at par. Now assume zero coupon bond is issued at 90 and redeemed at 100, which is face value. Which is face value. So for the investor, what is the gain? 10 rupees. For the investor, 10 rupees is the gain, and for the issuer, this 10 rupees is nothing but like a discount. Can he claim it as an expenses? Yes, he can claim it as an expenses. The issuer, that is the company, they can claim it as an expenses over the maturity period of the bond. For example, assume the maturity period of the bond is 10 years. So 10 rupees divided by 10 years. Every year they can claim a deduction of 1 rupees. Under which head, sir? PGBP. I have just given an example of one bond here. So number of bonds can be issued by them, guys, like lakhs together or thousands together. Is that clear? Yes. So the discount part will be an income for the investor, whereas it will be an expenses for the issuing company or the issuer in simple. Okay, fine. Then coming to the format which is given in section 48, how do we compute the capital gains income? Guys, our first task, whenever there is a capital asset and whenever there is a transfer of capital asset, our first task is first I need to classify whether the capital asset is a short term or long term. Sir, why? Because if there is a transfer of short term capital asset, I need to compute short term capital gain. And if there is a transfer of long term capital asset, I need to compute long term capital gain. And sir, why should we do it? Because the tax rate is different for short term as well as long term, guys. The rates are different. Clear? So it is very much important for us to classify whether the capital asset is short term or long term. Sir, that depends on what? How can we classify it? Guys, the classification of a capital asset depends on the period of holding. Sir, what is period of holding? It is a time gap between the date of acquisition and the date of transfer, guys. It is a time gap between the date of acquisition and date of transfer. Means how long did you hold the asset before you transferred it? Okay. So there are two category here, 12 months and 24 months. Three assets fall under 12 months criteria, rest all comes under 24 months, guys. So for the following three assets, which are listed securities other than the unit on a recognized stock exchange, and unit of equity oriented fund, and unit trust of India. Please be careful, only equity oriented fund is covered, whereas debt oriented fund will come here. Okay, yes, the last one is zero coupon bond. So for this three assets, 12 months is applicable, guys. So if these assets are held for more than 12 months before the transfer, then we call it as long term capital asset. If not, if it is held for less than 12 months or equal to 12 months, then we call it as short term. For any other asset other than this, 24 months is applicable, guys. For example, land, building, or unlisted shares, or debt oriented fund and all. Okay. So if this asset, that is any asset other than this three, okay, yes, if it is held for more than 24 months, it is long term. Less than or equal to 24 months, short term, guys. Okay, once we classify, then we need to accordingly calculate the respective capital gain. So if there is a transfer of short term capital asset, we need to compute short term capital gain. And if there is a transfer of long term capital asset, we need to compute long term capital gains. Now, if there is a short term capital gain on the transfer of LEFT, LEFT is a short form. Okay. So LE stands for listed equity shares, whereas F stands for units of equity oriented fund, and T stands for unit of business trust. T for trust, F for fund, LE for listed equity shares. Okay. So if there is a short term capital gain on the transfer of LEFT, then it is taxable at 20% on the entire amount as per section 111A. It is special in nature. Whereas if there is a short-term capital gain on the transfer of any other asset other than LEFT, then it is taxable at normal rate as applicable to the assessee, depending upon the scheme followed by them, guys. And this is treated as normal income. This is not special. Please be careful. Okay. Then coming to long-term capital gains, if there is a long-term capital gain on the transfer of LEFT, LEFT, that is same assets, guys. Three assets. Listed equity shares, unit of equity oriented fund, unit of business trust. Then it is taxable at 12.5%, but not on the entire amount, only in excess of 1,25,000. That is, only in excess of 1,25,000 it will be taxable. For example, assume long term capital gain on the transfer of LEFT is 2 lakh. Only 75,000 will be taxable at 12.5%. Sir, what if long-term capital gain on the transfer of LEFT is only 1 lakh? Then nothing is taxable. If it is within 1,25,000, nothing is taxable. Okay, yes. Then, if there is a long-term capital gain on the transfer of any other asset other than LEFT, then it is taxable at 12.5% as per section 112, guys. As per section 112. And whereas this is covered in 112A. Okay, yes, sir. Fine. There is some special rate with respect to land and building and all that I will cover it later. Don't worry. We have already covered it in tax rates, but still I will cover it once again later. Oh, fine. Guys, long-term capital gain will always be special, whereas short-term capital gain on the transfer of LEFT is only special, whereas any other asset, it is normal. Got it? Yes, sir. And as per section 50 AA, capital A, we will compute always short-term capital gain or loss on the transfer of the following three assets. So if there is a transfer of the following three assets, we will always compute short-term capital gain or short-term capital loss irrespective of the period of holding. We don't even check what is the period of holding for these assets. Okay. And how do we compute the capital gain? I will be covering it little later, which is mentioned in section 50 AA, guys. Okay, sir. Fine. Let us see what is the format to compute capital gains. Guys, if you remember, I already told you, wherever I have given the format in this color in my revision book, this is the format given in the law and you have to stick to it. Please don't make any changes for it. Okay. Sir, how do we compute short-term capital gain? First, we will take full value of sale consideration, which is nothing but sale value. From that, we will deduct the expenses on transfer. That is nothing but that at time of sale. Any expenses is incurred like brokerage, commission or anything. Okay. So once we reduce expenses on transfer from full value of sale consideration, we get net sale consideration, and from that we deduct cost of acquisition and cost of improvement. Okay, and what is each of this? We will also discuss it later. Okay, I'm just explaining the format. Each one of this I will explain in detail later, guys. Okay, so once I deduct this, we get gross short-term capital gains. And if assessee is ready to reinvest this amount in new asset, for short-term capital gain, you can claim exemption under section 54B and 54D, and the remaining will be taxable. Okay, sir. Then how do I calculate the long-term capital gain? Same format, but for long-term capital asset, we can claim indexation for cost of acquisition and cost of improvement. But now Madam has made a change. Okay, that is on or after 23rd July 2024. The indexation is available only for land and building, which is sold by resident, individual, and HUF. But anyway, indexation is a part of your syllabus. You should know it. When it is applicable, you need to calculate. If not, sir, I have sold long-term capital asset on which indexation is not available. Then what can I do, sir? Just claim cost of acquisition and cost of improvement. That's all. Indexation will not be available for you. Got it? I will talk about indexation in detail after this, guys. Okay. So for long-term capital asset, till year everything remains same, whereas cost would be indexed cost of acquisition and improvement. Okay. Once I reduce, we will get gross long-term capital gain. And if assessee is ready to reinvest this amount into a new assets, then he can claim exemption under section 54, 54B, D, EC, and F. Against long-term capital gain, exemptions are available, which are in more sections, guys. More exemptions are available. Okay, then we derive taxable long-term capital gain, and this is the figure on which the assessee is supposed to pay tax. And if by chance, if question is silent about exemptions, then ignore, guys. For both short-term as well as long-term, ignore the exemption. So automatically, gross only will become taxable in that case. Got it? Yes, sir. Fine. Next. So section 45 we already learned, which is a charging section for capital gains head, but there are few exceptions for it. What are those? We will see, guys. See, the general rule here, as per section 45 subsection 1 is, capital gains shall be chargeable in the previous year in which the transfer takes place. Normally, the transfer will take place during our previous year, guys. That is 25-26, and we will be computing the capital gains on it. But there are three exceptions where the date of transfer will be different, but it will be taxable in some other year. In which year, sir? In the year in which the assessee will receive the amount or receive the benefit, guys. So the transfer would have happened in 1 year, but it will be taxable in some other year. It can be taxable in the same year also, but in that case, it will not become an exception. Correct? So there are three special cases covered here where the transfer would have happened in 1 year, whereas it is taxable in some other year. When is it, sir? And how? We will see. First one. Insurance compensation received on destruction of an asset is taxable when it is actually received. For example, assume, guys, my asset was destroyed by fire in the current year, on which I had taken insurance policy. Now, the date of transfer is the date of destruction in the current year. Yes. But insurance company paid me the compensation, assume in the next year. So we will compute the capital gains in the current year. The date of transfer will be nothing but the date of destruction. But the year of taxability is the year in which I received the compensation, guys. Is that here? The calculation, computation, everything will happen in the year of transfer, which is nothing but year of destruction. Whereas only the payment of tax, that is the taxability, will be postponed to the year in which the compensation is received, guys. So in that case, what is the full value of sale consideration, sir? The value of money received. If insurance compensation is received in money, I will take it. Sir, what if it is given in the form of asset? Then whatever is the fair market value of the asset which is received, no, as a compensation, we will take that. Okay, sir. Then conversion of capital asset into stock in trade is taxable in the year in which the stock is sold. Now, if capital asset is converted into stock, then is it a transfer? Yes. But when is it taxable? When this stock is sold, guys. So when the stock is sold, actually, we need to pay tax on both capital gains income as well as business income. And to compute capital gains income, what is the full value of sale consideration, sir? As we have not sold, There is no sale value, yes, but whatever is the fair market value of the capital asset on the date of conversion, it will be taken as full value of sale consideration to compute capital gains income. And the same will be allowed as an expenses or cost to claim business income, to calculate business income. Okay, I have given here, you can see. Sale value to compute capital gains income is fair market value of the capital asset on the date of conversion. That is the date on which the capital asset is converted to the stock. That is the date of transfer. On that day, what is the FMV of capital asset? We need to check. Okay. And the period of holding and indexation, if at all if it is available, will be till where? Till the year of conversion. Okay, the period of holding will end on the date of conversion, guys. The date of conversion. And if it is a long-term asset and if indexation is available, then that also will be only till that date. That is the date of conversion. Fine. Next, compulsory acquisition of capital asset is taxable in the year in which compensation is first received. If by chance, if compensation is received in the installment, then whenever the first compensation is received, it will be taxable then. So when is compensation received is, assume guys, I had a land which is compulsorily acquired by government authority for maybe for national highway extension or for construction of national highway or for metro project, and they are paying me the compensation. So normally government also know that they will not pay it on time. There will be delay in payment. So that is why the date of transfer is the date of compulsory acquisition. The calculation, everything, the period of holding also is still that date. But when should I pay tax on this capital gains income is when I actually receive the compensation. When I actually receive the compensation. And even if indexation is available, it is only up to the date of compulsory acquisition, guys. Got it? Yes, sir. Chalo. Actually, in my provision book, I have given illustrations for each of this case. At least one I will go through. Okay, that is on compensation. Yes, you can just observe here. And actually, guys, the indexation is not available if the date of transfer is after 23rd July 2024. It will be available only for land and building which is sold by resident, individual and HUF. But if a asset is sold or transferred before 23rd July 2024, is indexation available for long-term assets? Yes, indexation is available. Okay. So this can be an exception cases. So please be careful. Fine. So this is an illustration, that is when compensation on compulsory acquisition is received as per section 45 subsection 5, guys. Okay. Land was purchased on 20th May 2015 for 50 lakh, and it was compulsorily acquired by government on 12th June 2023. Okay, date of transfer. Date of transfer. And compensation of 75 lakh was received on 20th July 2025. So which date should I lock, guys? This date, date of transfer. So period of holding will be from year to year. Okay. So is it a long-term asset? Yes, sir. You can see here, I have mentioned here. It is a long-term asset. Now, when I am computing the capital gain, is indexation available? Yes. Actually, here it is land. Even if it is any other long-term asset also, indexation is available. Why, sir? Because the date of transfer is before 23rd July 2024, guys. Okay, sir. Fine. So, how do I compute the capital gains? Full value of sale consideration 75 lakh. Assume there is no expenses on transfer and all. So, indexed cost of acquisition. How do we calculate indexation and all? I will teach you. Don't worry. I hope you guys already have a knowledge of it. But still, I will take care of it little later. Now, observe. Cost inflation index for the year of transfer. Year of transfer is what? 23-24. What is the cost inflation index? 348. Divided by cost inflation index for the year of purchase, that is 15-16. So how much is that? 254. So you will get index cost of acquisition. Index cost of acquisition. So remaining is taxable as long-term capital gain in which year? Guys, this is a gain which arised in the year 23-24, but it will be taxable in the year 25-26. That is when compensation is received. So this figure has to be included in the total income calculation of an assessee in which year? 25-26 under the head capital gains, guys. Hope you understood. Same way, I have also given the illustration for the first two cases also, guys. I will just show you. You can just pause the video and go through it. Yes, I will go back. I will go back. Yes. So let me talk in detail about this conversion part, guys. Okay, because as it is connected to two different head, I just want to explain both the scenarios. One which we already covered in PGBP head, the other one which we are covering now. Okay, so please pay attention. Please pay attention. So if the stock is converted into capital asset, it is taxable under the head PGBP. Sir, what amount is taxable under the head PGBP? The fair market value of the stock on the date of conversion is taxable under the head PGBP. When, sir? In the year in which it is converted. In the year in which it is converted. Okay. Now the assessee holds what? Capital asset. If by chance, if we sell this capital asset, then is it a transfer? Should we compute capital gains? Yes, guys. In that case, the period of holding will be from when to when? From the date of conversion, that is when it was converted from stock to capital asset, till the date of transfer. Okay. And what will be the cost of acquisition? Actually speaking, I didn't purchase this capital asset. I had purchased stock, which is now converted into capital asset. But when stock was converted into capital asset, whatever was the FMV of the stock on the date of conversion was taxable under that PGBP, right? Now that is allowed as cost. That is allowed as cost to compute what? Capital gains income. So what was taxable under the head PGBP is now allowed as cost to compute what? The capital gains income. Oh. Sir, what if this asset is sold? Then, sorry, what if asset is sold? We already seen. Sir, what if this capital asset is used by assessee in the business? Then he can claim depreciation on that asset? Yes. So you need to add this asset to the block? Yes. At what value? FMV. FMV, whatever we took here, no, same thing. We will take it as actual cost of an asset in order to add it to the block. Is that clear? And this is only if the capital asset is used in the business of an assessee. Okay, sir. Then coming to what is covered in section 45. That is, what if capital asset is converted into stock? Guys, see, if I sell capital asset, it is taxable under the head capital gains? Yes, sir. Now, what if it is converted into stock? Then even that is considered as transfer. Whatever is the fair market value of the capital asset on the date of conversion will be considered as full value of sale consideration, guys. So when capital asset is converted into stock, it is a transfer. We need to compute capital gains. And what is the full value of sale consideration means? The fair market value of the capital asset on the date of conversion. Okay. And what would be the period of holding to decide whether the asset is short term or long term? The period of holding will be from date of purchase of this capital asset till the date of conversion. Date of purchase to date of conversion, guys. Okay. But when is this capital gains taxable, sir? The year of transfer is the year of conversion. But when is it taxable? It is taxable when the stock is sold, guys. So when the stock is sold, we need to compute PGBP income. Okay. Sale value of stock minus cost. What is cost in that case? Whatever was the FMV year, no, to compute capital gains income will now become cost of acquisition for the stock. Got it? Just a reverse case. What was there here? No, it is a reverse scenario here. Okay, sir. So to compute business income, we will take the sale value of the stock. From that, we will reduce. From that, we will reduce the fair market value of the capital asset on the date of conversion. That will be allowed as what? Cost of acquisition here. And both business income as well as capital gains income, both will be taxable in the year in which stock is sold. In the year in which stock is sold, guys. Is that clear? Yes, sir. Actually, in my question bank, the first question is actually on that. You can see assessee has converted the capital asset into a stock. Fine. Then he has sold the stock. You can just go through it in detail. You can just observe. I will just explain the format here. Okay. So 9,50,000 is the fair market value of the capital asset on the date of conversion. Yes, sir. From that, I will reduce the indexed cost of acquisition, which is actual cost I will take and apply indexation. And it's a long-term asset. And what is the date of transfer? Just a minute. Here he sells this asset for 15 lakh in 25-26. So the date of conversion is in the financial year 21-22. So is indexation available for this asset? Yes, indexation is available. Okay, sir. So accordingly, cost inflation index for the year of transfer divided by cost inflation index for the year of purchase we need to take. Okay, sir. So we will compute long-term capital gain, but it will be taxable in the year 25-26. That is the year in which stock is sold. And we should also compute the business income, that is stock is sold for 15 lakh and whatever was the full value of sale consideration year will become cost year, 9 lakh 50. Remaining is taxable as business income. Both this income has to be included in the total income of the assessee in the year 25-26. That is the previous year 25-26, guys. Yes, I have also given the detailed explanation here and all. Please go through it, guys. Fine, so next, points on computation, expenses on transfer. So in the format, we saw expenses on transfer, cost of acquisition and all, no? Yes, for both short term as well as long term. What is it in detail? We will learn now, guys. Okay. Expenses on transfer. Expenditure incurred only and exclusively in connection with the transfer, like brokerage, stamp duty, registration fee, legal fee, or commission, etc., is allowed. And if by chance, if question is silent about it, you can ignore it. Assume there is no expenses on transfer. Okay. Then coming to first, what is cost of acquisition, sir? Guys, whatever is the purchase price which I have paid to purchase an asset is called cost of acquisition. Okay. But for long-term asset, indexation is available. But is indexation available for all the assets as on today? No, guys. As I told you, for long-term capital asset, indexation has been removed from 23rd July 2024. 23rd July 2024. On or after 23rd July 2024, if there is any asset transfer which is transferred, which is long-term in nature, indexation is not available. But indexation is available only for land and building, which is transferred by resident, individual, or HGR. I have given a note here. Just a minute. I will show. Yeah, this note. I will just read it before we cover about indexation. Indexation is not available if transfer takes place on or after 23rd July 2024 for long-term capital asset. Except means for this indexation is available. Except land and building transferred by resident, individual or HUF acquired before 23rd July 2024. And even for this there is a twist. What is it? I will explain later. Actually, I have already covered it. If you remember, along with illustration, I have explained in tax rate chapter. This indexation is available, but only while calculating tax for resident, individual, and HGF. Okay, but anyway, sir, are we supposed to know the indexation effect, sir? You are telling indexation is removed for long-term assets and all. Yes, guys, you should know it. I gave you a few examples, no illustrations and all, especially on this cases. Okay, that is in this case, the year of transfer might be last year, whereas it might be taxable in the current year. In that case, are we supposed to know the indexation effect and all? Yes, guys. And indexation is very much part of your syllabus. So you are supposed to know it. Got it? Yes. So we will learn it. So it will play a role in your questions, guys. May not be in every question, but at least in some questions. Okay, chalo, we will see. Index cost of acquisition. If the asset is acquired before 1st April 2001, 1st April 2001 is like a base date for capital gains income, guys. Okay. So cost inflation index is given for all the years, guys. 2001 2 is like a base year for us. Okay. For which the cost inflation index is 100. Whereas 25-26, which is our previous year, the cost inflation index is 376. You are supposed to remember this too. Rest all for in between the years, if cost inflation index is required, they will give it in the question. They will give it in the question, guys. Okay, sir. Fine. So if an asset is purchased before 1st April 2001, then what should we do? First, we need to decide cost of acquisition. What is cost of acquisition means? The actual cost which is incurred to purchase an asset or FMV as on 1st April 2001, whichever is higher. Sir, why are they doing this? Because cost inflation index is available only from 2001 to. So if you have purchased an asset before that, we need to take actual cost, compare that with FMV and take whichever is higher as cost of acquisition. And on that figure, apply indexation. So cost of acquisition into cost inflation index for the year of transfer divided by cost inflation index for the base year, which is 100. Okay, sir. Exceptions. In case of intangible asset, we will not take FMV and all. Straight away, we'll take actual cost only as cost of acquisition. Okay, sir. And if in case, if a capital asset is a land or building, then we need to follow the following steps. What is it, sir? We need to compare the FMV and stamp duty value as on 1st April 2001 and take whichever is lower. Then compare that with actual cost and take whichever is higher. And that is called as cost of acquisition. And we need to apply indexation for this figure, like how we have done here. For other assets, we take only FMV, whereas if it is a land or building which is purchased before 1st April 2001, we need to take both FMV as well as stamp duty value. In the first step, compare both of that and take whichever is lower. Then compare that with actual cost and take whichever is higher, guys. Got it? Yes. Next, for the asset which is acquired on or after 1st April 2001 by the assessee, then straight away, no comparison of FMV and all. Straight away take actual cost as cost of acquisition and apply indexation. That is, cost inflation index for the year of transfer will be the numerator divided by cost inflation index for the year of acquisition, guys. Clear? And whenever you are applying indexation, just make sure that the cost inflation index which is in the numerator should be higher than what is there in the denominator, guys, because the cost inflation index for the year of transfer will always be in the numerator, because by mistake student might interchange this. Please be careful. And whenever you are applying indexation, indexed cost of acquisition will always be more than cost of acquisition, guys, after applying indexation. Yes, sir. And cost inflation index, whatever we are calculating, okay, or index cost of acquisition, it is available only for long-term assets. This benefit is not available for short-term assets. And as I already mentioned, now this indexation, even for long-term capital asset, has very much restricted usage, guys. Got it? Yes, sir. So please listen here. If the date of transfer, guys, please listen. If the date of transfer is after 23rd July, on or after 23rd July 2024, indexation is available only for the land or building which is transferred by resident individual or HGF. And that too, indexation is available only to compute tax liability. Whereas to compute the capital gains income, which has to be included in the total income calculation, you need to compute long-term capital gain without indexation only. Without indexation itself. Clear? That effect I will explain little later. Okay. Sir, what if the date of transfer is before this? Is indexation available for long-term assets? Yes, guys, it is available. So please be careful. Normally, the date of transfer will fall in our previous year. That is 25, 26. So in such case, no indexation except these two assets. Correct? But we discuss few exceptions where the year of transfer can be the past year, whereas it is taxable in the current year. If that is the case, you have to be careful with indexation, guys. Clear? And I also showed you the illustrations and all, where I have considered the indexation effect, guys. So please be careful with it. This illustrations, whatever I shown here, I've actually considered the indexation effects because the date of transfer would be before 23rd July 2024, guys. Okay. Yes. Fine. Fine. So next, fifth point we will see. But before that, I just want to discuss for some few special cases, guys. Few special cases. Actually, what is transfer is given in section 2 clause 47. Correct? Yes, sir. But there are few transactions which actually is a transfer. But for income tax purpose, they are given in section 46 and 47 that they are not transfer. They are not transfer, and accordingly we will not compute capital gains on that. I repeat, under section 46 and 47 of Income Tax Act, they have given the list of transactions which are not regarded as transfer, and accordingly when this transaction arise, we will not compute capital gains income, guys. So which are those transactions? One by one I will try to explain with an example and chart. And please be very attentive, guys. This is very, very important because it will also have an impact on cost of acquisition, period of holding and all. So please be very attentive. Okay. And try to catch whatever I am trying to explain, because different scenarios I will cover it. Okay, fine. First one, whenever there is a liquidation of a company, so a liquidator will be appointed by a company. Yes. Assume guys, there is a A Limited which is going into a liquidation, and Mr. A is a shareholder of A Limited. Okay, sir. Now, if liquidator of A Limited sell all the assets, capital assets, then is it a transfer? Should we compute capital gains? Yes, we need to. Okay. Sir, what instead of selling the capital asset and then giving the money to the shareholder, the liquidator thought, okay, let us give the asset only to the shareholder. He distributed the asset of the company to the shareholder. So when company or liquidator distribute the assets of the company to the shareholder on liquidation, it is not a transfer and we should not compute capital gains. This is given in which section? Section 46. Okay. Now Mr. A got the asset from the company, no? Yes. If he sell this asset in the future, is it a transfer? Of course. Should we compute capital gains? Yes. And in that case, what would be the period of holding? The period of holding will be from the date of distribution till the date of transfer. That is, from the day Mr. A received it till the day he is transferring it. That would be the period of holding. Okay. And what will be the cost of acquisition? The fair market value of the capital asset on the date of distribution. So whatever asset Mr. A received, no, the fair market value of that on the date on which he received it. That is, A Limited distributed it and Mr. A received it. No, on that day, whatever was the fair market value of this capital asset will be treated as cost of acquisition. Will be treated as cost of acquisition. Okay. This is with respect to the capital asset which is distributed by A Limited to Mr. A, and if we sell it in future. Now at the time of liquidation, now A Limited is giving an asset to the Mr. A, or they are giving money to Mr. A. Okay. And Mr. A has to surrender the shares which he is holding, no? Yes. Because from tomorrow, company will not be in existence. Yes. So Mr. A, whatever shares is holding, is surrendering it to the company. Sir, is it a transfer? Yes, transfer of shares. Should we compute capital gains on it? Yes. And in that case, the period of holding will be from the date of purchase of shares by Mr. A till the date of liquidation, guys. And to compute capital gains in the hands of Mr. A, what is the full value of sale consideration? If A Limited is giving money to Mr. A, we need to take money value. Or if A Limited is distributing the asset to Mr. A, then we need to take fair market value of that asset which A is receiving. And to the extent of the reserves which is held by A Limited, assume A Limited gave the asset worth 10 lakh to Mr. A and they had a reserves and surplus of 2 lakh. So to the extent of 2 lakh, it will be taxable in the hands of Mr. A as deemed dividend, guys, under the head income from other sources. So remaining 8 lakh we need to take here. Or else if I take 10 lakh here, I need to deduct 2 lakh here. So in simple, full value of sale consideration will be 8 lakh and remaining 2 lakh will be taxable under the head other sources, guys. Is that clear? So simple. I repeat. We need to take the fair market value of the capital asset which Mr. A has received. From that, we need to deduct the deemed dividend as per section 222C, which is nothing but to the extent of the reserves which company had at the time of distribution of asset on liquidation. Assume that is 2 lakh. So to compute capital gains income, what is the full value of sale consideration? 8 lakh. Is that clear? And this is only if company had some reserves. What if company didn't had any reserves? Then straight away 10 lakh we need to take. Got it? And this is a concept which is covered under the head income from other sources. Okay, sir. Now, whatever was the fair market value of the asset of which Mr. A received, this will be allowed as cost if he sell this capital asset in the future, which we already discussed. Clear? That is, whatever capital asset company distributed to A, if we sell it in the future, it is a transfer, right? Yes. We need to compute capital gains. And what is the cost of acquisition while computing capital gains? Means whatever was the fair market value of the capital asset, which was taxable in the hands of Mr. A, for what? For surrendering the shares. That will be allowed as cost, guys. Got it? Please be careful when asset was distributed by A Limited. It was not taxable in the hands of company, but for that Mr. A surrendered his shares. No, is it a transfer for him? Yes. Transfer of what? Not this asset. It is a transfer of shares held by him. Got it? Yes, guys. Fine. Let us move forward. And if by chance, this charts and all is not a part of revision material, guys. This I have took the help of my wife to draw all this chart. Okay, concept is mine, but she has definitely helped me writing this charts. If at all, if you want to make a note of this, you can just pause. Once I am completed or once I'm done with the explanation, so what do you do is you just pause the video and you can make a note of it. Yes. Okay. I will move forward. Next, partition of HUF. Now, HUF had various assets. Now they are getting partition. They are distributing all the assets to their members. Now, if HUF distributes the assets on partition to their members, is it a transfer? No. Should we compute capital gains? No, because it is covered in section 47, not a transfer. And in the future, member, whatever capital asset he received from HUF on partition, if he sell it in the future, is it a transfer for him? Of course, yes. Should we compute capital gains? Yes. In that case, what would be the period of holding? The period of holding will include the period held by member as well as period held by HUF. Both we need to take it. And what is the cost of acquisition, sir? Cost of acquisition will be cost of acquisition for HUF, because originally who purchased this asset? HUF. So cost of acquisition for HUF will be considered as cost of acquisition for whom? Member. So actually in the law they use the word cost of acquisition for the previous owner. So who was the previous owner? HUF. Got it? Yes. Next, gift or will. So if there is any gift or will or inheritance of a capital asset by an individual or HUF, it is not a transfer. And hence we will not compute capital gains because it is covered in section 47. But exception is ESOP shares. That means if I have gifted my ESOP shares to anyone without consideration, is it still a transfer? Yes. We need to compute capital gains on it. So ESOP shares is an exception for it, guys. Okay. I've given one example here. Assume father gifted or passed on the capital asset to a son under a will. So when son received it or when father transferred it, is it a transfer? No. Should we compute capital gains? No, guys. It is covered in section 47, so it is not a transfer. Okay. But whatever asset son received, what if he sell it in the future? Is it a transfer? Yes. Should we compute capital gains? Yes. So the period of holding will be the period held by son as well as period held by father. And what would be the cost of acquisition for son? Son didn't incur any expenses to purchase this. He got it bitty freely. Okay. In that case, cost to the previous owner will be taken as cost of acquisition for the son, guys, which is cost to the father. Cost to the father. Okay, sir. Next, coming to the amalgamation. Okay, little lengthy topic. Please be attentive, guys. This is with respect to both the asset transferred by company also is there and even shares. Both are there. Both the effect is there, but I have anyway differentiated it through a colors. Yes, this is a case of amalgamation. Okay. Now assume the Maruti Motors of India and Suzuki of Japan. They both got amalgamated and they are forming a new entity called Maruti Suzuki. This happened long back, but I am taking it as an example. Okay. Now, Maruti Motors and Suzuki is called amalgamating company and Maruti Suzuki is called amalgamated company. Oh, so this two companies will now cease to exist and a new company called Maruti Suzuki will be formed. For that, all the asset held by Suzuki as well as Maruti Motors would be transferred to Maruti Suzuki, right? Yes, sir. Is it a transfer? No. Should we compute capital gains? No. Where is it covered? In section 47. Provided Maruti Suzuki is an Indian company. Provided Maruti Suzuki, that is the recipient, should be an Indian company. Okay, sir. Fine. But in the future, if Maruti Suzuki sell this asset which they received either from Suzuki or Maruti Motor, assume, let me take it from one side. Assume they received a capital asset from Maruti Motors. No, now they are selling it. Now they are selling it. Is it a transfer? Yes. Should we compute capital gains? Yes. And what would be the period of holding? The period of holding will include the period held by Maruti Suzuki as well as Maruti Motors, both. And what is the cost of acquisition? This asset was originally purchased by Maruti Motors. So, whatever is the cost of acquisition incurred by Maruti Motors will be allowed as cost of acquisition for whom? Maruti Suzuki when they sell the asset. Cost to the previous owner. Is that clear? Sir, what if he doesn't sell at all? Then this transaction will not come. They kept on using it for business means. This will not come, guys. That's all. If at all, if it is there, then what I have given. Okay. Fine. And please be careful. Be familiar with these words, guys, that amalgamating and amalgamated company, because sometimes in the question they use these words, amalgamating, amalgamated and all. And even in the provisions, actually, they have used this word. So in my example, I repeat, amalgamating company means Maruti Motors and Suzuki, whereas amalgamated company means Maruti Suzuki, the new entity, guys. Okay. So whatever I have discussed till now is from company's point of view. Now let us discuss from shareholder point of view. Okay, which I have given in green color, guys. Now assume Vikas was a shareholder in Maruti Motors. He was holding the shares in Maruti Motors. Now when Maruti Motors is amalgamating with Suzuki, now I need to surrender my shares in Maruti Motor, and for that they will give me the shares where? In Maruti Suzuki. Okay, I have to surrender the shares of Maruti Motors because they will cease to exist. In place of that, they will allot me the shares in Maruti Suzuki. So when I surrender the shares of Maruti Motor, is it a transfer? No. Should we compute capital gains? No, we should not. Okay. Where is it covered? Section 47. Okay. Now I will get the shares of Maruti Suzuki. Now in the future, if I sell the shares of Maruti Suzuki, which I have got now at the time of amalgamation, is it a transfer? Yes. Should we compute capital gains? Yes. And what would be the period of holding? The period of holding is the period of holding of Maruti Motors shares plus period of holding of Maruti Suzuki shares. Both we need to take. Okay. And what is the cost of acquisition? Actually speaking, I didn't purchase Maruti Suzuki shares. Originally, I had purchased the shares of what? Maruti Motors. At whatever price I had purchased the shares of Maruti Motors, no, that will be the cost of acquisition for which shares now? Maruti Suzuki, guys. Again here. Cost of acquisition for Maruti Suzuki shares when I sell it is the cost of shares, that is Maruti Motors. Got it? Yes, sir. Interesting. Interesting case. Yes. Yes. You can just pause and look into it if you want. Just make a note of it also. I will move forward. Okay. Next is demerger. Okay. Sir, first we saw merger. Okay. Like marriage. Now we are seeing the case of divorce. Yes. Chalo. Divorce between whom, sir? Companies. Okay. That is called demerger. Okay. Fine. Now there was a Reliance Industries, okay, which is a conglomerate company. Now one of their wing they want to demerge as what? JFS. And the ratio of demerger is, let us take it as 5%. It was actually 4% change, but I am just taking it as 5%. Okay. So 5% of Reliance Industries is demerged as Geo Financial Services as a new entity. A new entity has been formed. We call this as a resulting company, whereas Reliance Industries, we will call it as demerged company. Okay. Now, whatever asset was held by Reliance Industries, 5% of that, they will transfer it to JFS. Yes. So, if there is any capital asset transferred from Reliance Industries to JFS, is it a transfer? No. Should we compute capital gains? No. Where is it given? In section 47. But one condition is the receiver should be an Indian company. That is, the resulting company should be an Indian company. Okay, sir. Next, in future, whatever capital asset which JFS received, no, normally they will use it in the business. They will not sell it. But what if they sell? What if they sell? Is it a transfer? Yes. Should we compute capital gains? Yes. So what would be the period of holding? The period of holding is the period of holding of Reliance Industry, means how long did Reliance Industry held this asset plus how long did JFS hold this asset? Both we need to take. Okay. And what is the cost of acquisition? This capital asset was originally purchased by Reliance Industries. So whatever is the cost of acquisition for Reliance Industries, the same thing will now be allowed as cost of acquisition for whom? JFS. Got it? Yes. This is from company's point of view. Now let us discuss from shareholder point of view. Assume guys, Vikas was a shareholder in Reliance Industries Limited. I was holding the shares. Now in case of demerger, Reliance Industries will continue. They will not stop their operation. Okay. A part of Reliance Industries has gone out and they are formed as a new entity. Okay, sir. Now, whoever was holding the shares in Reliance Industries was given a share in JFS, and it was in 1:1 ratio. So whatever number of shares I am holding in Reliance Industries, I will get equivalent number of shares in JFS, guys. Okay, sir. Fine. So now, after this demerger, I am holding the shares both in Reliance Industries as well as JFS. In the future, if I sell either the shares of Reliance Industries or JFS, is it a transfer? Should we compute capital gains? Yes. But you should know that I have not paid anything to purchase the shares of JFS. But whatever is the cost of acquisition of Reliance shares, no, it will be split between the cost of acquisition of Reliance and JFS. For example, assume I had paid 1,000 rupees to purchase the shares of Reliance originally. Now it will be split in the ratio of demerger. So after demerger, what is the cost of acquisition of Reliance shares? 950. And what is the cost of acquisition of JFS shares? 50. It will be split in the ratio of the demerger, guys. Clear? And anyway, whatever I just now explained, no, that is actually not a part of your syllabus. You need not worry. But anyway, for your knowledge sake, it is good to know. Okay. Yes. And please be careful. After demerger, there will be totally two company, Reliance as well as JFS. Reliance will not shut down. Okay, that will happen in amalgamation, but not here. Got it? Yes, sir. Fine, guys. Oh, fine. I will move forward. Next, conversion. So if there is a conversion of an asset from one form to another form, for example, preference share is converted into equity shares, or debentures is converted into equity shares, or debenture certificate is converted into debenture. Sir, is it a transfer? No, guys. Should we compute capital gains? No. Where is it covered? In section 47. In section 47. Guys, I told you, whatever we are seeing is the list of transactions which is not regarded as transfer. Only one transaction is given in section 46. Rest all is given in 47. That is liquidation only is given in 46. Rest all of them is given in 47, guys. Okay, that is distribution of an asset by a company at the time of liquidation to a shareholder is given in section 46. Rest all of them, whatever we are learning now, is given in 47. Okay, sir. So if preference shares is converted into equity shares, or if debentures is converted into equity share, it is not a transfer, hence we will not compute capital gains. But sir, what if this equity share is sold in the future? Then is it a transfer? Yes. Should we compute capital gains? Yes. And what would be the period of holding? The period of holding will be the period of holding of equity shares plus preference shares. Both we need to take. Clear. And what is the cost of acquisition? Cost of acquisition is the cost of acquisition of preference shares, because the assessee didn't pay anything to purchase equity shares. Originally, he purchased preference shares, which was like convertible preference shares, which is now converted into equity shares, and then equity shares is sold. In that case, the cost of acquisition is nothing but the cost of acquisition of the previous asset. Clear? Even if debenture is converted into equity shares. So for equity shares, what is the cost of acquisition means? The cost of acquisition of debentures. Got it? Yes, sir. Next, gold. This is interesting. Gold, the most valuable asset, yellow metal. Yes. Guys, assume let us take your example. You had purchased 10 grams of physical gold. PG stands for physical gold for rupees 1 lakh. Now the value is much more, but I've just taken a round figure 1 lakh. Assume 1 lakh. You have purchased 10 grams of physical gold for 1 lakh. And now you fear, if I hold this, what if someone steal it? Or what if I myself lose it? Can I go and convert it into electronic form? Yes, you can convert it. Okay. But before that, sir, if by chance if I sell physical gold, jewelry, first of all, is it a capital asset? Yes. Even though it is a personal asset of movable nature, still it is a capital asset. Okay. So if I sell this 10 grams of gold or a part of it, is it a transfer? Yes. Should we compute capital gains? Yes. And what would be the cost of acquisition? 1 lakh, whatever I have paid to purchase it. Okay. But now I'm not selling it. And I don't want to hold it also because I fear what if I lose it or if someone steal it from my house. So I just want to convert that into electronic gold receipt. That is, it is gold can be held in electronic form. Okay. For which I approached Vault Manager. Vault Manager. Okay. So I approached Vault Manager to convert my physical gold into EGR, that is electronic gold receipts. So when physical gold is converted into EGR, is it a transfer? No. Should we compute capital gains? No, guys. It is covered in section 47. Now, can I sell this electronic gold receipts? Yes, you can sell it in the electronic form. And if it is sold, is it a transfer? Yes. Should we compute capital gains? Yes. And what would be the period of holding? Period of holding will be the period of holding of physical gold plus EGR, both. And what is the cost of acquisition? Cost of acquisition of physical gold, which is 1 lakh. Which is 1 lakh. Okay. This is if EGR is sold. No, no, sir, I didn't sell EGR. Now, I want to reconvert my EGR into physical gold. Why? Because my relatives are not respecting me without physical gold, sir. So I want to wear it and show my relatives so that they will respect me in all my family functions. So I went and approached the Vault Manager again and asked him, sir, please convert my EGR into physical gold. So this part, blue one. Okay. So if EGR is reconverted into physical gold, is it a transfer? No. Should we compute capital gains? No. And it is as per section 47. And obviously for this, Vault Manager will be charging you some amount. Okay. Fine. So now what do I hold? What do you hold? What do you hold? Physical gold. Clear? Because you converted EGR into PG again. Okay. Now, if you sell this physical gold, is it a transfer? Yes. Should we compute capital gains in your hands? Yes. And what is the cost of acquisition? Cost of acquisition is the cost of acquisition of EGR. And what is the cost of acquisition of EGR? Cost of physical gold. It is like a cycle. Okay. Now, for EGR, what was the cost of acquisition? 1 lakh. Now, that is reconverted into physical gold. What is the cost of physical gold? Cost of EGR, which was 1 lakh. It is just like a cycle, guys. Okay, so the cost of EGR will be the cost of physical gold, which is 1 lakh. What went? Again came back. Okay. And the period of holding will be the period of holding of EGR plus physical gold. Both put together. Total period we will take. Okay, sir. Fine, guys. So this is with respect to converting the physical gold into electronic gold receipts or reconverting the electronic gold receipts into the physical gold. Okay, next. Now, there is one non-resident who is transferring the capital asset, which is government securities, to another non-resident. Means one non-resident is transferring the government security, which is a capital asset, to another non-resident outside India. Section 47 is telling it is not a transfer, hence we will not compute capital gains. Hence we will not compute capital gains, guys. Got it? Yes. So these are all the transactions which are not regarded as transfer, guys. Okay, sir. Fine. So most of them will also have an impact on period of holding and cost of acquisition, which we have covered together, guys. Okay. Come back to point number 5. Come back to point number 5. Guys, normally the cost of acquisition means the purchase price of capital asset, which is paid by the buyer or the assessee to purchase an asset. But in few cases, it may be different. What are those? If it is a self-generated goodwill, the cost of acquisition will always be nil. If it is a purchased goodwill, we will take purchase price. Then, if stock in trade is converted into capital asset, we will take fair market value, which I explained, conversion scenarios. Okay. Fair market value of the stock on the date of conversion. Then, if asset become the property of an assessee, that is the recipient, on gift, will, inheritance, or distribution of an assets of HUF to their members on partition or amalgamation or demerger. So what would be the cost of acquisition for the receiver? Cost to the previous owner. And sir, what if the cost to the previous owner cannot be determined? We don't know. And the previous owner is gone forever. Okay. Yes, in that case, we will take the FMV on the date on which the capital asset become the property of the previous owner as the cost of acquisition. Clear? At least this you try to get it. First preference is for this. If by chance if this is not available, then FMV of the asset on which the previous owner became the owner of an asset. Okay. Okay. Fine. Next. So where shares of an amalgamated, this shares amalgamation thing and all we already covered, guys. Then even liquidation part I have already covered. This sweat equity shares. Actually, I covered this in salary head, but let us repeat it because as it is little long back, I don't know when exactly you would have studied or you would have watched the video on salary, but anyway, I will repeat it. Okay. Where capital asset or sorry, where capital gain arises from the transfer of specified security or sweat equity shares referred to in section 17 subsection 2 which talks about perquisites, the fair market value which has been taken into account for perquisite valuation will be allowed as cost of acquisition, guys. I will just explain this with an example. Yes. Now assume employer, that is a company, allotted shares to employee under ESOP plan or under sweat equity. Okay. And employee paid 120 rupees to purchase these shares. It is allowed at or it is issued at discounted price. Actually, the fair market value of the share is 150 on the date of exercising the option. So for employee, whatever is the discount, 30 rupees will be taxable. Will be taxable as what? Perquisite under the head salary. So 30 rupees will be taxable, guys, as perquisite. Okay. Now, if by chance, if this shares, whatever employee got, if he's selling it in the future, should we compute capital gains income for him? Yes. And what is the cost of acquisition? Is it 120 or 150? 150. 150, guys. He has paid only 120, but remaining 30 was taxable in his hands under the head salary, no? Yes. So under capital gains, we will claim 150 rupees as cost, guys. Okay, sir. Fine. This is done. Next, where the capital gain arises from the transfer of such property which has been subject to tax under section 56 to 10. 56 to 10 talks about the gift taxation under the head other sources, guys. Now, if an assessee has received either the movable property or immobile property as a gift, then the stamp duty value or the fair market value will be taxable in his hands if it is more than 50,000. Correct. And whatever he received as a gift, if he sell it in the future, whatever was taxable for him when he received it under the head other sources as gift, that is either the fair market value or stamp duty value, will be allowed as cost to him when he sell this asset in the future. Got it? So this actually this provision is covered in income from other sources, that is 56 to 10. I will also explain there, but anyway, whatever is taxable under the head other sources when he received the gift, that is the either fair market value or stamp duty value, will be allowed as cost if that asset is sold by the recipient in the future, guys. Oh. Then with respect to electronic gold and physical gold, I covered it in my example, 1 lakh cost. It will just come as a cycle, no? That part. Okay. Then coming to right shares. Right shares is interesting. Now, assume Mr. X was already holding 1000 shares in X Limited. Now X Limited gave him a right to purchase some more shares of X Limited at only rupees 10 each. At rupees 10 each, discounted price. Okay, this is the right given to the existing shareholder. Okay. Now if Mr. X used this right, and purchase the shares, what is the cost of acquisition for him? It will be 10 rupees, guys. It will be 10 rupees. Okay, sir. Then second option. No, sir, he doesn't want to purchase the shares because he's already holding 1000 shares. No. So he doesn't want to purchase more shares. Now, whatever right he has got, can he sell that right to someone else? Yes. Now assume Mr. X is selling the right to Mr. Y for rupees 2. Should we compute capital gains in the hands of Mr. X? Yes. For sale of right, we need to compute capital gains. So what is the sale value? 2 rupees. Assume 2 rupees per share. And what is the cost of acquisition for the right? Nil. Because he didn't pay anything to purchase the right. Okay? Yes. Next, coming to Mr. Y, who purchased the right from Mr. X. Assuming using that right, Mr. Y purchased the shares from X Limited by paying how much? 10 rupees. He need to pay 10 rupees to the company. So if Mr. Y sell this asset, that is shares in the future, what is the cost of acquisition for him? It will be 10 rupees which he paid to company plus 2 rupees which he paid for Mr. X. Got it? Yes. And please be careful. If Mr. X himself use the right, then this cannot come. If he is not using the right, assume he is renouncing the right to Mr. Y. For Mr. X, we need to compute capital gains on the transfer of right, where the cost would be 0, whereas sale value would be 2 rupees. And Mr. Y, when he purchased the shares from Y Limited, what is the total cost of acquisition for him? 2 rupees what he paid to purchase the right plus 10 rupees what he paid to purchase the shares. Totally 12 rupees. And this 12 rupees is the cost of what? Cost of shares. Clear? Because I cannot consider it as a cost of right because he cannot sell this right again in the future because he has used this right and he has purchased the shares, guys. Okay, I will just read it. Right shares. Assume Mr. X himself is purchasing the shares. Amount paid to acquire the shares, which in my example is 10 rupees. What if right shares which are purchased by a person in whose favor the assessee has renounced the right entitlement? That is, Mr. X renounced his right to Mr. Y. So for Mr. Y, what is the cost? Price paid to acquire the shares, which is, sorry, price paid to acquire the right, which is 2 rupees, plus price paid for acquiring the shares, which is 10 rupees. So totally 12 rupees, guys. Got it? Yes, sir. Next, bonus shares. Bonus shares, if it is allotted prior to 1st April 2001, then actual cost for bonus shares will always be nil. Compare that with FMV as on 1st April 2001. We need to take whichever is higher. So straight away you can take FMV as on 1st April 2001, guys, because anyway cost will be 0. Oh. Next, what if bonus shares are allotted on or after 1st April 2001? Then we will always take actual cost, which is nil. Which is nil. Okay. Bonus shares are allotted free of cost to the shareholder. Company is doing it only to capitalize their profits, guys, because the amount would be transferred from reserves to capital. Amount will move from where to where? From company's point of view, from reserves to share capital. Okay, fine. So, what if it is a bonus shares, which is listed equity shares allotted before 1st February 2018? Means bonus shares is allotted before 1st February 2018, on which STT has been paid at the time of transfer. Then, as per section 112A, we need to calculate the cost of acquisition, which is the higher of actual cost, which is nil, and lower of FMV as on 31st January 2018 or the actual sale consideration. So straight away, whatever lower we will get here, no, we need to take that as cost of acquisition. Because once if I compare this with cost of acquisition, we will get whichever is higher as this one only. Got it? Yes. Sir, what if it is normal shares which is purchased by the shareholder? Okay, this is about bonus shares. Okay. Now, we discussed already LEFT, no? Listed equity shares, units of equity oriented fund, and units of business trust. These are the three assets which are covered under section 112A. And if these assets are purchased before 1st February 2018, this is the date on which section 112A was introduced, guys. Before that, long-term capital gain on the transfer of these assets was completely exempt actually. Okay, so, but from 1st February 2018, section 112A was introduced to tax it. Okay. So if these assets are purchased before 1st February 2018, then the cost of acquisition would be higher of actual cost of acquisition or lower of FMV on 31st January 2018. FMV means it is nothing but the highest quoted price on 31st January, guys. Okay. And actual sale consideration. We need to compute like this. This only if this assets, that is LEFT, is purchased before 1st February 2018. Sir, what if these assets are purchased on or after 1st February 2018? Then this calculation will not come. We should straight away take actual cost. We should straight away take actual cost. So please be careful. Same provision would be applicable only if it is a listed equity shares which is allotted as bonus shares before 1st February 2018. Same provision, but in that case, if it is a bonus shares, actual cost would be what? Nil, guys. It would be nil. And this calculation, whatever I have given here, is applicable only for LEFT, which is covered under section 112A and purchased before 1st February 2018, guys. Got it? Yes, sir. I have a question on it. Just a minute. Yeah. Question number 6 in my question bank, you can see. I will quickly go through. Mr. Satya is a salaried employee. In a month of January 2015, he purchased 100 shares of X Limited at rupees 1400 per share, cost of acquisition, actual cost per share from Bombay Stock Exchange. Okay, when he is purchasing from BSE or NSE, it is understood that he has paid STT, guys, because it will be automatically deducted. These shares were sold through BSE in April 2025, that is during our previous year, for 2600 per share. The highest price of X Limited share quoted on the stock exchange on 31st January 2018 was 1800 per share. So is it a part of LEFT? Yes, it is a listed equity shares, guys. So what will be the nature and amount of capital gain? As it is a listed shares and held for more than 12 months before the transfer, it is a long-term asset. And we need to compute long-term capital gain as per section 112A. Okay. So what is the full value of sale consideration? 2600 per share into 100 shares. So 2,60,000. Then cost of acquisition shall be higher of actual cost, which is 100 into 1400 actual cost, lower of highest price quoted on 31st January, which is FMV, 100 into 1800, 1,80,000. Then actual sale consideration is 100 into 2600, which is 2,60,000. So whichever is lower, 180. Compare that with 140, take whichever is higher, 180. That is the cost of acquisition, no indexation and all. Under section 112A, no matter when you have sold it, there is no indexation benefit, guys. Okay. So 80,000 is the long-term capital gain under section 112A. Include entire 80 in capital gains head. But while calculating tax, it will be zero. Why? Because it is within 125. Because it is within 1,25,000, guys. Okay. Same question, but what if the shares were purchased on 15th June 2020? Guys, here, share were purchased on what date? January 2015. Before 1st February 2018? Yes, sir. Okay. So it was purchased in Jan 2015. Okay. Whereas here, it is purchased after 1st February 2018. That means this benefits will not come, guys. So in that case, the calculations will remain same. Only the cost part will change. So the actual cost will be allowed as cost of acquisition here, guys. Why? Because here it is a long-term shares. Okay, that is the share is held for more than 12 months before the transfer, but it is purchased after 1st February 2018. So that means we can claim only actual cost as cost of acquisition. Got it? Yes, sir. Let us move on. Sixth point. If no cost has been incurred for acquisition, then it will be taken as nil, guys. It will be taken as nil. If I have not paid anything, but there are few exceptions, like if I have received any capital asset as a gift, will, or inheritance and all, for that we need to take the cost of previous owner. Except that if there is any other case where I have not paid anything to purchase the share, then the cost of acquisition would be nil. And under the head capital gains, if securities is a capital asset, and when I transfer it, if it is taxable under the head capital gains, then security transaction tax will not be allowed as an expenses, guys. If securities is a stock, then when you sell it, it is taxable under the head PGBP. And there you can claim STT as your business expenditure. But if securities, if buying and selling security itself is my business, then it will be a stock for me, taxable under that PGBP. Can I claim STT as my expenses? Yes. But if securities is a capital asset for me, assume I am just holding the shares or securities as an investment. So it is a capital asset for me. When I transfer it, we need to compute capital gains income. And in such case, can I claim STT as a expenses? No, I cannot claim. I cannot claim, guys. Okay. Next, notional transfer of goodwill on the admission or retirement of a partner, which you guys would have done for accounting purpose and all. Is it a transfer? No. For income tax purpose, we don't treat it as transfer, guys, because that is just a book adjustments. Okay. And in case of gift will partition and HUF, we have discussed all this, guys. This I have already explained it through a charts. Then, okay, 11th. Any compensation or enhanced compensation received by an individual or HUF on compulsory acquisition of agriculture land in specified area, that is urban area, is exempt under section 10 clause 37, guys. So if an agriculture land in urban area which is owned by individual or HUF is compulsorily acquired by the government authority, whatever compensation that individual or HUF is receiving is fully exempt under section 10 clause 37. And please be careful, this exemption is available only for agriculture land in specified area. What if it is any other land or building? Then exemption is not available. Sir, what if it is an agriculture land situated not in specified area, means in urban area? Sorry, if it is situated in specified area, urban, okay. Sir, what if it is situated in a non-specified area, which we call it as rural area? In that case, it is not at all a capital asset, guys. Rural agriculture land is not at all a capital asset. Hence, if you have sold it or if it is compulsorily acquired, it is not at all a transfer. We won't compute capital gains. And what is specified area? I have already covered it in chapter 1 when I was explaining the agriculture income definition, guys. Got it? Yes, I repeat. If the agriculture land is in specified area, then we treat it as urban agriculture land. It is a capital asset. But if agriculture land is not situated in specified area, then we call it as rural agriculture land. It is not a capital asset. Okay? Yes, sure. Next, enhanced compensation received is chargeable in the year of receipt and cost of acquisition will be nil. What is enhanced compensation? Assume, guys, my land is compulsorily acquired by government authority and they have fixed a compensation as 50 lakh. But I know my property is worth more than that. So I put a case against the government authority to claim 80 lakh as the compensation. But now court gave a judgment telling because you are supposed to receive a compensation of 70 lakh. That means 20 lakh more than what they had already fixed. They had already fixed how much? 50 lakh. Now I will receive an enhanced compensation of how much? 20 lakh. Will that also be taxable in my hands? Yes, in the year in which I receive it. And when I receive it, can I claim any cost? No, no. Because when I received the original compensation 50 lakh, I would have already claimed cost, guys. Next, redemption of preference shares amounts to transfer and chargeable to capital gains, guys. So if there is any redemption of preference shares, is it a transfer? Yes, capital gains will be computed. Next, 14th one. Advance money is received and forfeited by the assessee, that is the present owner, when the transfer didn't take place. For example, I wanted to sell my property. You came in search of it and you told Vikas, sir, your house is very good, very nice. I am giving you a token advance of 2 lakh. Take it, sir. Don't sell it to anyone else, sir. I will just come in 1 week. I will pay you the remaining amount and we will get the property transferred. Okay, I agreed for it. You gave me a token advance of 2 lakh and you asked me to wait for 1 week, but you never came back. Can I forfeit this money? Yes. So is it an income for me? Yes. So how should we treat that 2 lakh in my hands is given here. It depends on when did I receive it and forfeit it. If the advance money is received and forfeited before 1st April 2014, then it shall be reduced from the cost of acquisition of an asset when it is further sold. And if by chance, if indexation is available, we need to reduce the advance money received and forfeited before claiming indexation. That is from actual cost, reduce the advance money received and forfeited. On the remaining amount, you claim indexation. Okay, sir. Then, what if the advance money is received and forfeited on or after 1st April 2014? Then, it shall be taxed in the year of forfeiture under the head income from other sources. And if it is taxed in the year of forfeiture under the head other sources, if this property is actually sold in the future, will we reduce it from the cost again? No, no, no. It is already taxed when you have received it under the head other sources, guys. Is that clear? So the treatment of advance money received and forfeited depends on when did you receive it and forfeited it. Oh, next. We have some special transactions under the capital gains head. The first one is section 46A, buyback of securities. Guys, if there is a buyback of ESOP securities which is allotted by a company to its employees, then it is taxable in the hands of the shareholder as per section 46A. Normal capital gains calculation we need to do. That is the sale value, which is buyback price minus the cost of acquisition. Okay. Then if there is a buyback of any other shares other than ESOP by a domestic company, whether listed or unlisted, then it is taxable in the hands of shareholders, but as dividend income, deemed dividend. Whatever is the buyback price, no, it will be taxable in the hands of shareholder under the head income from other sources as dividend income. And no expenses can be claimed against this dividend income, guys. Sir, what about the cost of purchase of shares? it will be allowed as a capital loss under the head capital gains. Cost of acquisition will be allowed as capital loss under the head capital gains, whereas the buyback price will be taxable in the hands of shareholder as dividend income under the head other sources cash. Okay. Now, actually, in the recent budget, they have removed this. Last year, they introduced it, and in the current year, they have removed it. But don't worry, whatever has been removed, no, that is not applicable for your syllabus because it is as per Finance Act 2026. So, Finance Act 2026 will be applicable only for your exams from May 2027 and onwards, guys. Okay. Sir, what if there is a buyback of shares other than ESOP from a company other than domestic company? Let us consider it as foreign company. Then it is taxable in the hands of shareholders as capital gains income, not as dividend income. It is taxable as capital gains income as usual calculation. These two provisions remain same, whereas this only is different. Okay, this didn't make any sense. That is why they also felt, even government felt that this will not make any sense and they have removed it. But anyway, this provision is applicable for your exams till Jan 2027, guys. Okay, fine. Next. Guys, while discussing depreciation under section 32 under the PGBP head, I had mentioned section 32 will fail in two scenarios. Immediately, section 50 will take over. Sir, in which are those two scenarios? That is when all the assets in the block are sold or when there is no value in the block. So simple, when there is no asset or when there is no value in the block. Section 32 fails, immediately section 50 will take over. And under section 50, we should always compute short-term capital gain or short-term capital loss, guys. We don't even check the period of holding. And what is the format to compute the short-term capital gain or loss? Oh, we need to take full value of sale consideration. From that, we need to deduct three items. What are those? Expenses on transfer, opening return on value, and additions to the block, if any. Additions to the block means purchases. But this purchases should be done before the sale. Before the sale. Okay. So once if I deduct all this, I will be getting short-term capital gain if it is a positive figure. If it is a negative figure, it is a loss, guys. And please be careful. This will always be short-term in nature and it is a normal income. Sir, is it a special income covered under section 111A? No, no. It is a normal income taxable at normal rate. Okay. Then we have one more 50 AA. Even here, we will always compute short-term capital gain or short-term capital loss irrespective of period of holding. Even for this assets, we never check the period of holding. So what are those? We will see. Short-term capital gain on the transfer of units of a specified mutual fund acquired on or after 1st April 2023. Sir, what is specified mutual fund means? More than 65% has to be invested in debt and money instruments. So in simple, I can call it as debt mutual funds, guys, or debt oriented funds. Okay, fine. Then a market linked debenture whose performance or returns depends on the market performance. Okay. Or an unlisted bond or unlisted debentures. Unlisted bond or unlisted debentures. Yes, sir. Fine. Then, so if there is any transfer of these three assets, we don't even check period of holding. It is always short term. How do I calculate it? Full value of sale consideration or redemption value or maturity value. From that, expenses on transfer, if any is there, we will reduce. We will get net sale consideration from that cost of acquisition. We will get short-term gain or short-term loss. And it is a normal income taxable at normal rate, guys. Sir, can I claim a deduction for STT? No, there is no deduction for STT under the capital gains head, guys. Clear? And there was a saying that investment in securities or investment in market is subject to market risk, but now it is subject to Trump risk. Okay, so we need to read all his tweets carefully before making any investments. Yes, sir. Next, slum sale, section 50B. When the entire company or undertaking is sold by an assessee without assigning the values for individual asset, we call it a slum sale. And in that case, the undertaking itself is a capital asset. If it is held for more than 36 months before the transfer, then we call it as long-term capital asset. If it is held for less than or equal to 36 months, it is short-term. And please be careful, only here it is taken 36 months. Now actually we have only two periods, 12 months and 24 months, but only for slum sale under section 50B, we have 36 months criteria. Okay, yes. And what would be the full value of sale consideration means? The fair market value of the capital asset on the date of transfer. And we have two FMV, we need to take whichever is higher. Sir, what are those two FMV? FMV1 being the fair market value of the capital asset transferred by way of slum sale, and FMV2 is fair market value of the consideration received, whether in monetary term or non-monetary term, occurring as a result of slum sale, because sometimes the seller will get the shares in a new company. Clear? So in that case, we need to take the value of it. Sir, what if it is paid in money? Whatever money is received, we need to take it. Okay, yes, I will explain this with one question later. First, let me explain the provision fully. So FMV1 or FMV2, simple guys, value of the assets which I have given or the value of the consideration which I have received, whichever is higher is the full value of sale consideration. Okay. Then what is the cost of acquisition means? The net worth of the undertaking on the date of transfer based on book value. Based on book value. Sir, how do we calculate net worth? Assets minus liabilities. Assets minus liabilities. And all the asset has to be taken at book value. And if any asset has been revalued, please ignore the revaluation for computing net worth of an undertaking. Okay. And even though here the undertaking is held for more than 36 months and it is long term in nature, can I claim indexation for it? No. No indexation is available because net worth on the date of transfer is allowed as cost of acquisition. So it will not make sense to claim indexation there. Okay. So finally, what is the format to compute here, sir? Full value of sale consideration, that is higher of FMV1 or FMV2. Okay. If both are given, take whichever is higher. Sir, what if any one is given in the question? Take straight away that only. Okay. Then expenses on transfer, we will get net sale consideration. Then from that deduct cost of acquisition, which is nothing but net worth of an undertaking on the date of transfer based on book value. Then you will get long term or short term capital gain. Okay, sir. Fine. So let me just discuss one question on it. Come to question number 8 in my question bank, guys. Mr. A is the proprietor of Akash Enterprises having 2 units. He transferred on 1st April 2025 is unit 1 by way of slum sale for a total consideration of 25 lakhs. The fair market value of the unit on 1st April 2025 is 30 lakh. Unit 1 was started in the year 2006-7. Okay. It was started in 6-7 and it is sold during the previous year. So it is held for more than 36 months in long term, guys. Okay. And they have given the total consideration received is 25 lakh and the value of the asset on the date of transfer is 30 lakhs. So we need to take full value of sale consideration as whichever is higher, 30 lakhs. Whichever is higher, 30 lakhs. Okay. The expenses incurred for the transfer is 28,000. Okay. Balance sheet as on 31st March 2025. That is before, immediately before transfer is. They have given the value of building, machinery, debtors, other assets for both unit 1, unit 2. But what is required for me is only unit 1. Unit 2 is not relevant. Whereas liabilities they have given for the entire undertaking, including unit 1 as well as unit 2. But what is transferred is only unit 1, guys. Please be careful. Own capital 15 lakh, revaluation reserve 3 lakh for building of unit 1. Oh, that means the building of unit 1 is revalued upward. So should I remove this effect? Yes. So what is the book value of the building, guys? 9 lakh, which I need to consider for net worth calculation. Okay. Then bank loan is 2 lakh, but 70% of that is for unit 1. Trade creditors is 1 lakh 50, 25% of that is for unit 1. So we need to take only unit 1 value. Fine. Other information. Revaluation reserve is created by revising upward the value of building of unit 1. Okay, we will remove that effect while calculating net worth. No individual value of any asset is considered in the transfer deed. That means it is a slum sale as per section 50B. Then other assets of unit 1 include patent acquired on 1st July 2023 for 50,000 on which no depreciation has been charged. Okay, fine. So that means other assets is there. No, here it includes 50,000 which is for patents, and on that still no depreciation is claimed itself. On patent, which is an intangible asset, can we claim depreciation? Yes. How much? 25% per year. Correct. So should we recompute the book value? Yes. Because for a depreciable asset, book value means returned on value, guys. And for machinery and all, they have not given any information. Let us assume whatever value is given is the book value. Whereas for patent, we need to calculate the return on value, which we need to take as book value for net worth calculation. Okay. So it is a slum sale as per section 50B and the unit is held for more than 36 months before transfer. So it is a long term. And full value of sale consideration is how much, guys? 30 lakh. Expenses on transfer is 28,000. So net sale consideration is 29 lakh 72,000. Okay. Now net worth calculation is important. Building excluding the revaluation profit comes to 9 lakh. Machinery 3 lakh. Debtors 1 lakh. We will assume whatever they have given is the book value. For patent 50,000 is included in other assets. So let us remove it from other assets. Remaining 1 lakh I will take here. Whereas for patent, don't straight away take 50,000. We need to calculate return on value by reducing depreciation, which I have done here. So cost of acquisition on 1st July 2023 is 50,000 and it is used in the year 23-24. Is it used for more than 180 days? Yes. So full 25% depreciation. So amount comes to 12,500. So balance as on 1st April 2024 is 37,500. Then again for 24-25 charge depreciation at 25%, which comes to 9,375. Balance as on 1st April 2025 is 28,125. Okay. So this is return on value, which is nothing but book value for net worth calculation. Okay. Take it. Take it. And I have also given a note that for all other assets, we have assumed that whatever figures is given in the question is a book value. For building, we have just reduced the revaluation profit. Okay. Creditors and loan, we need to take only what is related to or what is attributable to unit 1. Once I reduce the liabilities, we get net worth on the date of transfer 12,50,625. Reduce it here, we will get long-term capital gain under section 50B, which is 17,21,375 guys. Got it? Yes, sir. Next, section 50C, which is applicable only for land or building. If land or building is a capital asset and if it is transferred, there is a high chances that the assessee can manipulate the sale value in the agreement and they might receive the money in cash. So in order to track it, in order to overcome that, the government has introduced section 50C, where we need to compare the actual sale value with stamp duty value of that property. If actual sale value is more than stamp duty value, take actual sale value as full value of sale consideration to compute capital gains income. Sir, what if stamp duty value is more than actual sale value? Up to 10% difference is okay, guys. But if stamp duty value is more than 110% of actual sale value, then we need to take stamp duty value as full value of sale consideration to compute capital gains income. And if in case, if assessee is objecting for it, telling, no sir, my property value is less than that, and if he is requesting the assessing officer can refer this case to valuation officer. And in that, this might not be there always. If at all, if it is given in the question, you will consider it. If not, you will stop it here only, guys. Okay. Now assume the assessing officer has referred the case to the valuation officer and valuation officer has given the value. And if stamp duty value is more than the valuation officer's value, then what do we take? Valuation officer's value, we will take it as full value of sale consideration. Okay. Sir, what if valuation officer's value is more than stamp duty value? Okay, in that case, we will take stamp duty value. Assessee will be like, sir, okay, take stamp duty value only, sir. Clear? Please be careful. This may not be there in all the cases, guys. Okay. And stamp duty value, we need to take it on the date of transfer. But, sir, what if date of agreement and date of registration is different? Normally, the date of agreement will come prior, guys. On that date, the stamp duty value might be lower when compared to the stamp duty value on the date of registration. So, if date of agreement and date of registration is different, stamp duty value on the date of agreement can be considered, provided at least a part of the consideration is received in any mode other than cash. In any mode other than cash means in what mode can we receive? Rule 6ABBA, which I covered at the end of PGBP head, guys. Account pay, check, demand draft, BIM, UPI, those things. Okay. And same to same provision. Okay, before that, I will just try to explain this with an example. Just a minute. Yeah. So you can see, assume the actual sale value, guys, is 50 lakh. And stamp duty value of the property, I'm just taking two different scenarios. Assume is 52 lakh. So stamp duty value is more than actual sale value. So should we straight away take stamp duty value? No. Check the difference. If the difference is up to 10%, it's okay. No problem. We will ignore stamp duty value. So take 110% of actual sale value, which is 55 lakh. 52 lakh is less than 55 lakh. So that means full value of sale consideration, we will take it as actual sale value only. Why, sir? Because the difference between actual sale value and stamp duty value is within 10%. That is acceptable. Okay. Next scenario. What if stamp duty value is 60 lakh? So take 110% of 50 lakh, which is 55 lakh. So that means stamp duty value is more than 110% of actual sale value. Yes. So that means difference is more than 10%. Yes. In that case, we will take stamp duty value on the date of transfer as full value of sale consideration to compute capital gains income, guys. Is that clear? Yes, sir. Now, sir, what if the case is referred to the valuation officer? Now, assume actual sale value is 50 lakh and stamp duty value is 75 lakh. So 75 lakh is more than 110% of 50 lakh. Yes. So this was supposed to be taken as full value of sale consideration, but assessee is objecting for it and is requesting the assessing officer to cross check again. So assessing officer has referred this case to the valuation officer and valuation officer gave any one of this value. Both cannot happen simultaneously, any one. Okay. Assume the valuation officer gave 75 lakh, 70 lakh. In that case, what is the full value of sale consideration, guys? 70 lakh. Sir, what if valuation officer gave 80 lakh, which is more than 75 lakh? In that case, full value of sale consideration would be stamp duty value. Got it? Yes, sir. And same to same provisions would be applicable for a land or building which is held as a stock for an associate, guys. This is only for a real estate developer or the person who is engaged in construction business. For him, land or building can be a stock or inventory. And when he sell it, where is it taxable? Under the head PGBP. In that case, we need to follow section 43CA. The provisions is same what we discussed under section 50C. But please be careful. 50C is applicable only if a land or building is a capital asset for an associate. Whereas 43CA is applicable only if land or building is a stock for an assessee and it is taxable under the head PGBP. I have given a small chart for it. You can see here. If land or building or both is held as stock by an assessee, then we need to check which section when he sell it. Section 43CA. To compute the income under the head PGBP, we need to compare the actual sale value with stamp duty value. Whereas if it is held as a capital asset, then we need to check section 50C to compute the income under the head capital gains. But the provisions is same. Clear? Yes. So whatever we discussed here would remain same for both the sections, but under two different heads, guys. So that is why, even though this is a part of PGBP head, I'm covering it here so that if you study it and along with section 50C, it will be very easy, guys, because the provisions is same only, no? That's why. Okay, sir. Then coming to the tax rates, actually tax rates is already covered in tax rates chapter, guys. I had a separate chapter, that is chapter 2.1 on tax rates, where I have also covered the tax rates on the special incomes. But let us just revise it once again here. I have given tax rates on capital gains income, which is special in nature. So this rates remain same for all categories of assessee irrespective of the scheme followed by him. So if there is a short-term capital gain on the transfer of LEFT, that is listed equity shares or unit of equity-oriented fund or unit of business trust, it is taxable at 20% on the entire amount. The condition is STT should be paid. Okay. And if there is any other short-term capital gain, it will be normal in nature. It will be taxable as per the rate applicable to the assessee, as per the scheme followed by them, and it is a normal income. Okay. Then, if there is a long-term capital gain on the transfer of the same assets, it is covered under section 112A, and the rate is here. It is it is different. Please be careful. 12.5% on long-term capital gain exceeding 1.25 lakh, guys. Include entire long-term capital gain under the head capital gains while computing total income, but while calculating tax liability, reduce 1,25,000. Only remaining will be taxable at 12.5%, guys. Okay, sir. Then coming to section 112, if there is a long-term capital gain on the transfer of any other asset other than LEFT, then it is covered under section 112. And long-term capital gain will always be special in nature, guys. Okay. Then, if the asset transferred is a land or building or both, which is acquired by resident individual or HUF before 23rd July, means they have acquired it before 23rd July, but if they are selling it after 23rd July, okay. In that case, what is the tax rate? Lower of 20% with indexation or 12.5% without indexation. And please be careful, this is only while calculating tax liability. Whereas while computing income, you have to compute long-term capital gain on the transfer of land or building without indexation, include it under the head capital gains, and compute total income. This benefit assessor will get only while computing tax liability, guys. Okay. Then, in any other case, except this, the tax rate is 12.5% on the gain without indexation, guys, including land or building or both acquired by resident individual on or after 23rd July 2024. Okay. And for land or building, the period of holding would be 24 months. Please be careful. Only if it is held for more than 24 months, we treat it as long term. Okay. Or any other assets acquired anytime, it will fall here. Okay. I have also mentioned here, in case of a non-residence, long-term capital gain on the transfer of unlisted securities or shares of a closely held company that is private would be taxable at 12.5% without indexation and without foreign currency fluctuation, guys, because these assets would have been purchased in foreign currency where the exchange rate might fluctuate, but no benefit of foreign currency fluctuation will be provided. Okay, sir. Fine. Next, I will explain this later along with one question. One illustration, actually, if you remember, I had already covered it in tax rates chapter, but anyway, I will explain again after this. Common points for section 111A, 112 and 112A. If assessee is a resident individual or HUF whose normal income taxable at a normal rate is less than basic exemption limit, then whatever is the shortfall, which we call it as unexhausted basic exemption limit, can be adjusted against capital gains special income, guys. Please be careful. This benefit is available only for resident individual and HUF, and the shortfall or unexhausted basic exemption limit can be adjusted only against capital gains special income. Sir, can it be adjusted against casual income or undisclosed income and all? No, sorry, only against capital gains special income. Okay, yes. So what is it? I will try to explain with few examples. Just a minute. Yes. Quickly observe, guys. I have given number of examples. Tuck, 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 tuck. I will go through. Now, total income of an assessee assume is 8 lakh under default scheme. DS stands for default scheme. In that, long-term capital gain under section 112 is 6 lakh. Normal income, which is taxable at normal rate, is 2 lakh. What is the basic exemption limit? 4 lakh. So there is a shortfall or unexhausted basic exemption limit of 2 lakh. Can you adjust this 2 lakh against long-term capital gain under section 112? Yes. Remaining is how much? 4 lakh into 12.5%. Into 12.5%. So the tax comes to 50,000 plus 4% cess. And can assessee claim a rebate under section 87A against this 50,000? No. Why, sir? Because it is a tax on special income. Tax on special income. Even though the total income is within 12 lakh, rebate under section 87A for an assessee who is following default scheme is not available against tax payable on special income. I have given that point here. You can see. D. We have covered this in tax rate chapter. Again, it is very important. So I am again revising it, guys. In case an assessee is paying tax under the default tax regime, rebate under section 87A is not available in respect of tax payable on any special income. Whereas if an assessee is following optional scheme, then rebate is not available against only 112A tax. Whereas it is available against tax on any other special income. So please be careful with this. Okay, sir. Going back to this. So no rebate on this. So assessee has to pay 50,000 plus 4% as tax. Okay. Next, tax total income of an assessee under optional scheme. Hello, optional scheme is 8 lakh. How much, sir? Long-term capital gain under section 112, 4 lakh. Short-term capital gain under section 111A, 2 lakh. And normal income, 2 lakh. So this is taxable at slab rates. The basic exemption limit under optional scheme, assuming the age is less than 60, is 2.5 lakh. So what is the shortfall? 50,000. Now I have a choice whether I can adjust this 50,000 against this or this. Adjust it in the most beneficial manner, guys. Most beneficial manner means adjust it against the capital gains income, which is taxed at a higher rate. So what do? I will adjust it here, 50,000. Remaining 1,50,000 is taxable at 20%, and here entire 4 lakh is taxable at 12.5%, assuming it is not a land or building at all. Okay. So now, is rebate available against whatever tax we are calculating here? No, because the total income is more than 5 lakh under optional scheme. Okay. Next, total income under default regime is 5,70,000, in which long-term capital gain under section 112 is 3,80,000 and normal income is 190. Basic essential limit is 4 lakh under default regime. So there is the shortfall of 2,10,000. Okay. Adjust it against the special income. Remaining is 1,70,000, which is taxable at 12.5%, assuming it is not a land or building. Okay. So the tax is 21,250 plus 4% cess. Sir, can I claim a rebate against it? No. As it is a tax on special income, no rebate is available under default scheme. Okay, so then the total income is 5,45,000 under default scheme, in which long-term capital gain under section 112A is 3,80,000 and normal income is 1,65,000. Okay. So basic essential limit under default scheme is 4 lakh. So there is a shortfall of 2,35,000. Adjust it against long-term capital gain. Can I do it, sir? Yes. Assuming in all these cases the assessee is the resident individual or HUF tax. Okay. 2,35,000. So remaining is 1,45,000, but up to 1,25,000 it is not taxable. Correct? No, under section 112A. Reduce that also. Remaining is 20,000 taxable at 12.5%. The tax comes to 2,500. Can I claim rebate against it? No, sorry, as it is tax on special income plus 4%. Add health and education cess and pay it. Okay. Next, what if the total income of an assessee is 5,70,000 under default scheme, in which long-term capital gain under section 112 is 3,80,000 and normal income is 190. So basic essential limit is 4 lakhs. So there is a shortfall of 210. So adjust 210 here. Remaining is 170. Reduce 125. Remaining 45,000 is taxable at 12.5%. No rebate here also. Okay, sir. So many things. It may look very simple, but so many things to consider, including rebate part. Okay. Total income of an assessee under the optional scheme is 4 lakh. Rebate is available. Okay. In which long-term capital gain under section 112 is 2 lakh. Normal income is 2 lakh. Okay. Basic essential limit under optional scheme, assuming age is less than 60, is 2.5 lakh. Shortfall is there 50,000. Adjust this 50,000 here. Remaining is 150. Taxable at 12.5%, assuming it is not a land or building. Okay. So 18,750. Is rebate available? Yes, it is available. As the total income is within 5 lakh under optional scheme, and here whatever tax we have calculated, it is under section 112. Under optional scheme, rebate is not available, only against 128 tax. Okay. But under optional scheme, maximum rebate is 12,500, guys. So claim 12,500 as rebate. Remaining 6,250 plus 4% is supposed to be paid. Okay, sir. Fine. Done with all these examples, guys. Hope it was helpful for you. I have tried to combine the concept of the shortfall adjustment along with rebate and all. Yeah. Next, assessee cannot claim any Chapter 6A deductions against the capital gain special income, guys. Actually, Chapter 6A deductions cannot be claimed against any special income, including capital gain special income. Okay. Yes, sir. Next, the maximum surcharge applicable on whatever tax we calculate on capital gain special income plus dividend income. The maximum surcharge rate is 15%, whether under optional scheme or default scheme, guys. Okay, sir. This rebate part we already seen. STT is not allowed as an expenses, so we have already seen that. Then indexation benefit for long-term capital asset. This is the one important point you have to take care, guys, because for most of the long-term capital assets, the indexation has been removed, but only, please pay attention here. If the long-term capital asset is a land or building, which is acquired by the resident individual or HUF before 23rd July, but if it is sold after 23rd July 2024, then for that land or building, while computing tax liability, indexation is available. Whereas while computing the income under the head capital gains, in order to determine the total income, indexation is not available. So you need to compute two figures. One, long-term capital gain on the transfer of land or building without indexation to compute the total income. Whereas to compute tax liability, you have to take this figure along with, you should also compute long-term capital gain on the transfer of land or building with indexation. With indexation, guys. Yes, sir. If you remember, I had discussed one illustration on this under tax rates chapter, guys. Clear? Yes. Sure. Now coming to the treatment of capital loss. Treatment of capital loss. Sir, what if an assessee has short-term or long-term capital loss? First, long-term capital loss. Any long-term capital loss, whether under section 112 or 112A can be adjusted only against long-term gain, guys, whether in the current year or even if it is carry forward. In the current year, if you don't have any long-term gain, you can carry forward it to the next 8 years. And even when you carry forward, long-term capital loss can be adjusted against only long-term capital gain. Any long-term capital gain, whether under section 112 or 12A. Coming to short-term capital loss, any short-term capital loss, whether under section 111A or even if it is a normal income. Short-term capital loss can be adjusted only against short-term gain or long-term gain. And if you don't have any gain in the current year, you can carry forward it to the next 8 years. And even when you carry forward, you can adjust it only against short-term gain or long-term gain. So actually, loss under the head capital gains can never go outside the head, guys. Can never go outside the head, whether it is current year or brought forward loss. Got it? Yes, sir. Then coming to the exemptions. Now, from the transfer of capital asset, whatever gain the assessee has earned, he need to pay tax on it. But if he is ready to reinvest this money into a new asset, an exemption is available under 54 series, guys. Under each section, they have told what is the asset which you should have transferred, from which you have earned a capital gains income. So I call this as old asset here. And which should be the new asset in which you should invest, and within what time should you invest, and what is the amount of exemption. All this they have specified. If all the conditions are satisfied, only then the assessee can claim exemption year, guys. So I have to be very careful while checking the conditions. And if by chance if question is silent about the exemption, you can ignore it. You can ignore the exemption, consider there is no investment, straight away gross will become taxable, guys. Okay, let us see one by one. Section 54 is applicable only for individual and HUF. The asset which is transferred, that is old asset, is a residential house. And from that, the assessee has earned long-term capital gain. And if he is ready to reinvest that amount in a new residential house, then he can claim an exemption under section 54. Sir, within what time a new residential house has to be purchased or constructed? Guys, here I have given the timeline here. If it is purchased at least 1 year before or 2 years after the date of transfer. If it is a construction, within 3 years from the date of transfer, construction has to be completed. Yes, just a minute. I will just show you the timeline here. Assume this is the date on which a old residential house is transferred. Now the assessee want to purchase a new residential house. What is the time limit? 1 year before this, you should have purchased, or at least 2 years from the date of transfer. Within this time period, you should have purchased a new residential house. Sir, what if you want to construct it? Within 3 years from here, you should have completed the construction of a new residential house, guys, in order to claim exemption under section 54. Hope you got it. For purchase, 1 year before or 2 years after. Totally deadline is still here. Whereas for construction, within 3 years from the date of transfer, guys. Got it? Yes, sir. Next. Section 54B. Applicable for individual or HUF, the asset transferred is agriculture land. And obviously, agriculture land in urban area. Okay. And it should be, that is the agriculture land before transfer should have been used by the assessee for agriculture purpose at least for 2 years before the transfer, or by his parents. Okay. And now he should invest that money into a new agriculture land. Within what time? Within 2 years from the date of transfer. Whatever I have given here, no, the time limit is from the date of transfer, guys. DOT stands for date of transfer. Okay. Next. 54D. There is a compulsory acquisition of land or building which was used by the assessee for industrial undertaking purpose. And this land or building was used at least for 2 years for business purpose by an assessee before the compulsory acquisition. In such case, whatever gain he is earning, if he is ready to invest in a new land or building which will be used for the industry purpose but in a new area, that amount he can claim it as an exemption provided he purchased the new land or building within 3 years from the date of compulsory acquisition. Okay, sir. Then 54EC is available for any assessee. Please be careful. 54D and EC is available for any assessee. Okay. Now 54EC. Long-term capital asset being the land or building or both. Now the asset which is sold is long-term capital asset which is land or building. So the assessee has earned long-term capital gains. Now if he is investing this within 6 months from the date of transfer in the specified bonds, he can claim exemption. Sir, what are those specified bonds in which the assessee can invest is the bonds issued by REC, PFC, IRFC or NHI, as well as now new two bonds are introduced, guys. These are amendment. Please be careful. UDCO bonds issued on or after 1st April of the previous year and IREDA bonds which is issued on or after 9th July of the previous year. Okay, sir. So if assessee purchased any of these bonds, then whatever amount is investing in this bonds within 6 months from the date of transfer, he can claim exemption under section 54 EC. But maximum exemption available is 50 lakhs, guys. 50 lakhs. Yes, sir. For all these sections, sir, what is the amount of exemption? The amount of exemption for all the section is the cost of new asset purchased or constructed or the gross capital gains, whichever is lower. The gross capital gain or the cost of new asset, whichever is lower. Okay. Whereas for 54F, the amount of exemption is different. Okay. What is it? It is available for individual HUF. The asset sold should be any long-term asset but not residential house. Any long-term asset but not a residential house. But what is purchasing should be a residential house. Guys, listen here. Under section 54, it was residential house to residential house. Correct? Whereas here, any long-term asset but not a residential house. But the new asset to be purchased is what? Residential house. Okay. Sir, within what time? Same timeline like 54. Same to same timeline. Okay. 1 year before or 2 years after the date of transfer. And if it is a construction, within 3 years from the date of transfer, the construction has to be completed. Okay. So what is the amount of exemption? I need to compare the cost of new residential house with net sale consideration. You know what is net sale consideration? Full value of sale consideration minus expenses on transfer. We will get net sale consideration, no, that figure. We need to compare the cost of new residential house with net sale consideration. If the cost of new residential house is more than net sale consideration, then entire gross gain, that is gross long-term capital gain, is allowed as exemption. Sir, what if cost of new residential house is less than net sale consideration? Then the amount of exemption will be cost of new residential house divided by net sale consideration into gross long-term capital gain. By applying this formula, we need to calculate amount of exemption. I repeat. If cost of new residential house is more than net sale consideration, then entire gross long-term capital gain is allowed as an exemption. Sir, what if cost of new residential house is less than net sale consideration? Then the amount of exemption is equal to cost of new residential house divided by net sale consideration into gross long-term capital gain. By applying this formula, whatever amount we get, that is allowed as exemption, guys. Okay. Now, for both the sections, that is section 54 as well as 54F, the maximum amount of exemption is 10 crore, guys. Maximum amount of exemption is 10 crore. If the cost of new residential house is more than 10 crore, assume it is 12 crore, we will restrict it to 10 crore. We will restrict it to 10 crore. And even for section 54 EC, the maximum amount of exemption available to an associate is 50 lakhs, guys. 50 lakhs. Okay, sir. Then some important shortcuts to remember with respect to the exemptions I have given you. So what are those? Withdrawal of exemption. Now, whatever new asset the assessee is purchasing to claim exemption, no, he cannot sell it immediately. He has to hold it for at least 3 years or 5 years. If he sell this new asset within 3 or 5 years, then whatever exemption he has already claimed, no, will be withdrawn. And what would be the pattern for this withdrawal I have given here? For section 54 EC and F, if a new asset which is sold within the specified period in the respective section, then the capital gain exempted earlier is taxable in the year of transfer of new asset. Means when a new asset is sold within the specified period, we need to compute the capital gain on the transfer of new asset plus whatever exemption was already claimed earlier, no, when this asset was purchased. even that amount will be taxable now. Even that amount will be taxable. When, sir? When the new asset is sold. So there will be two capital gains. Okay. Then for section 54, 54B and D, if a new asset is sold within the specified period which is given in the respective section, then the capital gains exempted earlier is reduced from the cost of acquisition while computing the capital gains on the transfer of new asset. So when the new asset is transferred, we need to compute capital gains on the transfer of new asset. Yes, we will take full value of sale consideration. From that, we will reduce cost of acquisition. But assume cost of acquisition is 50 lakh. For this, I had already claimed exemption when I purchased 30 lakh. Reduce 30 lakh. Only remaining 20 lakh you can claim. Only remaining 20 lakh you can claim. That means while computing the capital gains on the transfer of new asset from the cost of acquisition, whatever exemption was already claimed at the time of purchase will be deducted. Only remaining amount, if any, will be allowed as cost. And sir, what is the lock-in period for the new asset? Lock-in period for the bonds which is purchased under section 54 EC is 5 years, whereas for any other new asset which is purchased under any other section except 54 EC is 3 years. You have to minimum hold it for 3 years once you purchase it. Okay. Then applicability of sections. Section 54, 54B and F is applicable for individual or HF, any individual or HF, whether resident or non-resident, doesn't matter. And all these exemptions are available under both the schemes, guys. That is optional scheme or default scheme. One thing to notice, guys, default scheme will not have any negative impact on capital gains head. Sir, all the deductions, exemptions, everything is allowed under capital gains head? Yes. Whether the assessee is following optional scheme or default scheme, he can claim it. But only for rebate calculation and all impact will be there. But with respect to capital gains calculation and all, or even for claiming exemption, will there be any negative impact for an assessee who is following default scheme? No, guys. Okay. Because at the end of every head, I used to cover what is the impact of section 115 PAC on that particular head. Whereas in this head, I would have not given it in the revision material because there is no negative impact. Oh, fine. 54, 54B and F. Under this section, only individual or HF can claim exemption. Whereas under other sections, any assessee can claim exemption. Okay. Next. Type of asset transferred. Old asset. Okay. Means, sir, I have earned a capital gain from the transfer of old asset. No, sir. Which asset is that? Long term or short term? For section 54, 54 EC and F, they have clearly mentioned the asset transferred should be long term. Whereas for other sections, it can be long term or short term, guys. It can be long term or short term. Yes, sir. So now come back to page 1 where I have given the list of sections. So we are done with section 45 to 55A along with section 111A, 112 and 112A, guys. I just want to discuss one question. Just a minute. Shiva question. Shiva, yeah. Question number 5. This question I will discuss, guys. Okay, because it has a lot of things covered in this question. Very interesting. We'll quickly go through this. Mr. Shiva, a resident individual, purchased a house property on February 15, 1979. Okay, for 3,24,000. In addition, okay, let me underline all the important things. When did he purchase it? Before 1st April 2001, guys. Before base date. 3,24,000. In addition, he has also paid a stamp duty value at 10% on stamp duty value of 3,50,000. So on 3,50,000, 10% comes to 35,000, which has to be included in the actual cost. Okay, so actual cost means how much, guys? 3,24,000 plus 35,000. Next, in April 2008, Mr. Shiva entered into an agreement with Mr. Mohan for sale of such property for 14,35,000 and received an amount of 1,11,000 as advance. However, the sale consideration did not materialize and Mr. Shiva forfeited the advance. So, advance received and forfeited before 1st April 2014. It is before 1st April 2014. So, what should I do with this amount? We need to deduct it from the cost of acquisition when actually this asset is sold. Oh, next. In May 2015, he again entered into an agreement for sale of said house for 20,25,000 to Deepshika and received 1,51,000 as advance. However, Deepshika did not pay the balance amount. Mr. Shiva forfeited the advance. So what should we do with it? It is on or after 1st April 2014. So this 1,51,000, which is an advance received and forfeited on or after 1st April 2014, will be taxable in that year under the head other sources. Which year? Financial year 15-16, guys. In the hands of assessee. So again, will it have any impact when the asset is sold in the future? No, guys. Next. In August 2015, Mr. Shiva constructed the first floor by incurring a cost of 3,90,000. This is the cost of improvement, people. Cost of improvement. Next, on November 15, 2025, Mr. Shiva entered into an agreement with Manish for sale of such house for 50,50,000 during our previous year and received an amount of 1,50,000 as advance through an account pay check. Mr. Manish paid the balance entire sum and Mr. Shiva transferred the house to Mr. Manish on February 2026. Guys, finally the asset is sold. Okay. But this is the date of agreement and please be careful, this is the date of registration. So this is date of agreement, this is the date of registration. And on the date of agreement itself, he has received at least a part of the consideration in any mode other than cash. Okay, sir. On April 1st, 2001, the fair market value of the house property was 11,85,000 and stamp duty value was 10,70,000. Okay. So if a land or building is purchased before 1st April 2001, we need to compare actual cost with what, guys? The lower of FMV and stamp duty value as on 1st April 2001, and both are given here. Further, the valuation as per the stamp duty authority of such house on 15th November, that is date of agreement, is 60 lakh and on 20th February is 62 lakh. What should I consider, people? I should consider the stamp duty value on the date of agreement because at least a part of the consideration is received in any mode other than cash on or before the date of agreement. Got it? So should we consider 60 or 62 lakh? 60 lakh. Okay. Then compute capital gains in the hands of Mr. Shiva for assessment year 26-27. Okay. Cost inflation index and all is given. Guys, if they have asked you only to compute capital gains and not to compute tax liability, please compute capital gains without indexation. Okay. So asset here is an house or building which is held for more than 24 months before transfer. Hence, it is a long-term asset. We need to compute long-term capital gains, guys. Okay. So what is the full value of sale consideration? 60 lakh. I have given a working note for it. Detailed explanation I have given, guys. Simple. Stamp duty value, we need to take it on the date of agreement and it is more than 110% of actual sale value. 110% of actual sale value comes to 55,000, 55 lakh 55,000. So 60 lakh is more than that. So we need to take 60 lakh as full value of sale consideration. Sir, what about the valuation officer's value? If nothing is given, please assume there is no valuation officer's value. Assessee is accepting this. Okay, fine. So 60 lakh is the full value of sale consideration. Yes, sir. Next, expenses on transfer. Please be careful. It is 1% on sale value. 1% on sale value, guys. Okay, even though you're taking stamp duty value here, 1% has to be calculated on actual sale value of 50 lakh 50,000. Okay, so you will get net sale consideration. From that, reduce cost of acquisition and cost of improvement. Cost of acquisition calculation is very important. Okay. So as it is a land or building which is acquired before 1st April 2001, we need to first compare fair market value and stamp duty value on 1st April 2001. Take whichever is lower. Compare that with actual cost. Actual cost is 3,24,000 plus stamp duty paid. 350 into 10%, that is 35,000. We will derive actual cost as 359 and we need to take whichever is higher, guys. 1070. And in this case, advance money taken from Mohan and forfeited before 1st April 2014. That is this part. Mohan part. Mohan, where are you? This one. Yes, students. So deduct it, whereas what we received from Deepshika would have already been taxed in the year 2015-16, guys, or assessment year 16-17 under the head income from other sources. So should I reduce this again? No, not required. So we will get cost of acquisition 9,59,000. Take it here. And there is a cost of improvement which is incurred 3,90,000. We have to take it as it is. And what is cost of improvement, sir? Guys, cost of improvement means the capital cost which is incurred after the asset is purchased. After the asset is purchased. And just a minute, cost of improvement is also given here. Just a minute. Yes. So you can see what is cost of improvement means. It is a capital expenditure which is incurred by an associate after the asset is purchased. And if it is a cost of improvement incurred before 1st April 2001, we need to ignore it. Why, sir? Because it would have already been considered in the FMV of the property, guys. We will take here FMV of the property as on 1st April 2001, which will also consider the improvement done to the property. Yes. So if any improvement cost is incurred before 1st April 2001, then we need to consider that as nil. And if it is incurred after 1st April 2001, whatever is the actual capital expenditure, we need to take it. But if the capital asset is a goodwill or a right, then the cost of improvement will always be a nil. And if at all, if indexation is available for cost of improvement, then how do we apply it? Cost of improvement into cost inflation index for the year of transfer divided by cost inflation index the year in which improvement took place. Cost inflation index for the year in which the improvement took place, guys. Yes, sir. Fine. So we will reduce the cost of improvement. No indexation here. Even though it is a long-term asset, we are just computing the capital gains income. So without indexation, please calculate this. So 46 lakh 500 is a long-term capital gain under section 112 lakhs. Okay. So if they have just asked you to compute income, please stop it here. If by chance, if they have also asked you to calculate tax liability, then what, sir? Then what? I've given here. So you need to compute one more figure here. That is long-term capital gain with indexation. With indexation, guys. Sir, how is it? Full value of sale consideration, same figure. Expenses on transfer, same. Net sale consideration, same. Till here, everything same. Whereas cost of acquisition and the cost of improvement will be indexed. So indexation will be available now. So cost of acquisition is 9,59,000, which we already saw, into cost inflation index for the year of transfer, that is our previous year, 376, divided by cost inflation index for the base year, as the asset was purchased before 1st April 2001, guys. If it is purchased after 1st April 2001, then we will take cost inflation index for the year of purchase year. Okay. We will get 36 lakh 5,840. Then index cost of improvement. Cost of improvement is 3 lakh 90,000. Then on that, into cost inflation index for the year of transfer is the numerator, divided by cost inflation index for the year of improvement. So improvement took place in which year? Just a minute. Improvement took place in the year 1516. What is the cost inflation index for the year 1516? They are given in the question 254. 254, guys. Just remember the cost inflation index for the base year, which is 100, and for our previous year. Rest all in between, for any year if it is required, they will give it in the question. You need not worry. Yes, sir. So once we claim index cost of acquisition and index cost of improvement, we will get long-term capital gain with indexation, which is 17,66,337, guys. Okay, sir. Now let us calculate the tax figure. We have a long-term capital gain without indexation 46 lakh 500. On that, the tax rate is 12.5%, which gives us 5 lakh 75,063. Let us name it as A. Keep it aside. Then we have also computed long-term capital gain with indexation, which is 17 lakh 66,337. On that, the tax rate is 20%. We derive 3,53,267, which I am naming it as B. So lower of A or B is the tax payable by assessee, guys, which is 3,53,267. Very important point, guys. So if they want to keep the question complicated, they may include like this. Clear? And please be careful while computing the total income. Assume the question is on total income. You will include 46 lakh 500 as capital gains income. Under that, capital gains. Compute total income. And if they have asked you to calculate tax liability, do like this. And sir, in addition to this, assessee also has other income. On that, calculate tax as usual. However, we already learned. Whatever tax you get for that, you add 3,53,267 and continue with like surcharge, rebate and all. What rebate might not be available, but anyway, surcharge, sets and all will be as usual, guys. Got it? Yes, guys. So finally, we are done with capital gains head. I know by now, sir, it is almost 2.5 hours. We are tired, sir. Guys, I want you guys just relax for some time and take the question bank and try to practice all the questions. For all the questions, I have already given the solutions along with the note and working notes. It will be easily understandable for you. I want you guys also to practice few questions. Guys, please don't give up. I know if you just push yourself for another half an hour, 1 hour, you will be able to do best. Just imagine every day you are gaining 5 marks addition, then it will give you that cushion of margin of safety. So please push yourself for few more days, just few more days, guys, because just imagine yourself seeing that successful on your screen. You will be very proud about yourself, right? Yes. So the journey looks tough, but it's okay, guys. It's okay. You're almost there. Give your best, push yourself, and push as much as possible. If you're already studying, assume for 10 hours, try to push it for 11 or 12 hours. And you will definitely be able to make it, guys. Thank you.